the reason why it changes because it's an auction driven market, and moods and sentiment always offer you higher prices and lower prices. So I'm going to just connect with KK of Sundaram, but KK, you may want to hear me out because we have just looked at some data as to why one should not run away because there is red on the screen, because historically every bull market has corrected. 2017 in a sense spoilt us because that would be remembered as an outlier year of linear gains and low volatility. But if you look at history of Indian stock markets, and we've done some numbers here, what really has been the large major sell-off, and those special AR graphics are just telling you, in the previous bull market there was a 5% correction more than 11 times. Twice in the previous bull market we had a 10% correction, and the 2003 to 2008 bull market, the famous ultimate bull market which you've ever seen, there were 2 days when the markets actually were circuit down. The index was frozen. The index had fallen by more than 10%. So before we think it's end of the game, I guess we have to put things in perspective here and understand that bull markets will always correct because we had just seen a very linear rally. That's the nature of equity. That is the nature of equity investor. It comes with volatility, and if you are not able to recognize the asset allocation, then it's going to hurt you. KK, I think I've done all the talking today for you. I've really sold mutual funds very brilliantly in my initial remark and summary.
Yeah. Very clearly, I think, there is a very synchronized global rally led by very strong, economic data and earnings growth that we saw across the board in many markets, and so this basically, is a very, welcome correction in the sense that you do get, a little bit of reality check at this point in time, as there is again a reset in terms of how the global monetary conditions could change, and so the markets, kind of looking at that as an excuse to kind of, indulge into a profit-taking kind of a mode. So I would think that, corrections like this, which are very sharp and steep, also end in very quick recovery. Typically, if you have a very jagged kind of a correction, both in terms of price and in terms of time, then you do see a kind of a 3-6 months kind of a phase where there could be sideways movement and pain. But in instances in the past where you have seen a very sharp kind of sell-off, typically, the bounce back is also quite strong if the economic fundamentals are intact. We believe that, globally, the economies are in the midst of a growth cycle. Europe is still getting to that mid phase of the growth, whereas US probably is in an acceleration mode, and you are having countries in the emerging markets which are actually getting off into a growth path after a long down cycle in terms of growth. So all indications clearly point to a very strong economic growth, and which is good for equities. So so that's why we remain quite confident on the equity markets here, and we believe that corrections like this are good buying opportunities for people who missed the run earlier. So I would continue to be not worried by these corrections. We have seen, like you mentioned, in any bull market there are multiple corrections that help actually move the equities into a strong pair of hands. So I think we should look forward to using this correction to add to exposures to this growth economy.
The challenge with being a long-term bull, KK, is that the global scenario is changing and we are on the different side of global equation. Global growth is peaking out, local growth is yet to recover. Globally, valuations are way above their normal. So I don't worry about the local setup, I worry about the global setup. And if global markets they correct more, the sentiment could change again. 10 days ago, we were obsessed with the fact that there was enough and more domestic liquidity and bulls cannot put a foot wrong. And the same guys today are telling me that, okay, we want to protect the cash we have because these markets will fall more.
Yeah. See, the reason that I'm still not worried about the global setup is the fact I mentioned that the growth in various economies are kind of in an improving mode. US is kind of first off the block, and you are seeing a fairly strong growth there. Europe and other countries there, the major countries there are kind of into a 2% kind of growth at this point in time. So it's not that these economies are in a tearaway kind of a growth, and probably at a point where the monetary authorities will get extremely worried about the inflation, etc. Right? We are still below 1.8% core inflation in the US and much lower in the Eurozone. So it's not as if things are going to change immediately in the next 6-8 months. Definitely the glide path is up in terms of interest rates, in terms of the liquidity kind of easing, in terms of being pulled out by the central bankers. But that is in sync with the kind of improvement that you will see in the long-term growth, right? So I think as long as the growth equation is in our favor, I think the equities globally still have a lot of legs basically, and the asset allocation towards equities will continue to be much more favorable at this point in time. So as we talked about the Indian bull market going through a mild correction, there is also a mild correction in the global equities which have gone through a big bull market. So I think I don't read too much into a change in terms of global setup. I think what we have seen is something that we expected, that there will be 3 to 4 rate hikes in the US, and ECB towards the end of this year will start getting a little bit more hawkish. So all these things are fairly discounted. But some of the data points that came through, were the kind of excuse that people have to get a lot more anxious about faster rate hikes.
How long, KK, do you think would it take for the markets to absorb the changing dynamics in terms of easy money, as well as the way the bond yields are spiking up, and a change in scenario and stance by interest banks, not just in India, but across the globe, like you just mentioned?
See, I think as already you have seen, the US bond yields are cooling off at this point in time, so you are also seeing a little bit of cool off on Brent and other commodity prices too. So it's not as if there is a one-way runaway in inflation which will probably push the monetary authorities to rethink. So I think it's a fairly balanced growth out there. So we do not see this correction continuing for long. I think it should be a very short correction that we are seeing at this point in time. We also mentioned about valuations, right? So valuations in the last couple of weeks have already corrected significantly, and particularly in the mid and small caps, you had probably more than 10 to 12% kind of knockoff on various portfolios, and even at the Nifty level, valuations are down to 15 times on FY20 and about 17 times FY19. So getting more reasonable than where we were. So I think in the near term we should see some amount of stock picking, bottom fishing happening, and we should get to better times very quickly. I don't expect this correction to last very long.
You would bottom fish right now, KK. Would there be any classification in terms of mid or small caps, or should you stick with large caps, or would you hunt across the board and fish for quality?
I think the current correction provides investors an opportunity to buy those stocks which they always want to buy, but which are probably a little bit expensive because of the secular growth credentials and better quality managements and businesses. So definitely, one would use this correction to pile up on good quality stocks which have strong long-term earnings potential. that would be definitely something that one would do. And it's definitely a market where one has to be kind of more diversified across market caps. It's just not enough to just buy in the large caps which have fallen, but I think there are good quality mid and small caps also which have corrected with thin volumes and which have borne the brunt of some amount of profit taking. So I think across the board you have very good opportunities, and different market cap buckets provide all-round opportunities.
Finance Ministry official quotes coming in, which we will just address in a moment, attributing the fall to global markets melting rather than the whole LTCG issue. KK, your own assessment on that? What may have started locally, do you think then spiraled down because of weaker global markets and the global market crash, so to speak? So one can't really say that this market fall could be attributed to a disappointment coming in on the LTCG front.
See, while LTCG was something that people expected, so to the extent the impact of that when it came in the budget would have been moderate to the extent of the volatility we saw on the budget day. That would be probably how I would say it. Parallelly we have been having a bout of yields hardening and profit taking that's happened globally, which India also has been a part of the whole global sell-off. So I would think that it's a lot to do with the sentiment which got impacted from a global cues rather than local. I think the budget was more or less reasonable considering the pre-election year, and I think I would like to believe that the numbers are much more reasonable, and we would still be quite comfortable in terms of fiscal deficit and market borrowings. So I don't think the budget has much to do with the correction.
Yeah, no, that would be the case, I'd reckon. Just taking from the point that you made earlier about diversifying in this market, would you believe that would be the case, or this is a good time to actually get into large cap funds where there's the benefit of underperformance to mid caps over the course of 2017, and also this fall presents further upside potential at an absolute level as the index moves up in response to earnings which have started kicking in?
See, I think, like we have discussed also earlier, I think an investor needs to have a fair mix of large caps and mid cap allocation. So I would still think that it's reasonable to be balanced with a 65-35, 70-30 kind of mix of allocation towards large caps and mid caps in terms of funds or stocks. Having said that, I also want to add to the point that the earnings growth that you will see, that probably already you're seeing in the third quarter results, etc., are clearly showing that the mid cap segment has come back quite strongly in terms of earnings growth. And profitability improvement. So I would think that the kind of alpha of mid caps over large caps would continue on a sustained basis. But like we discussed earlier, it's going to be about 3 to 4% CAGR over the cycle. So so that's not that it's very, very strong in a single year. But if you have a compounding impact of that 4% over the cycle, it could be a pretty decent alpha that one would look forward. That's why I think it's good to have a mix of large and mid caps.
Right, KK, appreciate your time and thank you for joining us.